All right, today we are diving deep into the 2025 annual reports from four of the biggest names in agricultural machinery. In a year where farm income just cratered and interest rates went through the roof, we're going to find out who is really set up not just to survive, but to win the entire future of farming. Let's get right into it.
So, 2025, a brutal winter hit the farming market. And this number right here, this is the one that sent shockwaves all the way from Wall Street to the Midwest. That's the revenue drop for John Deere's main division, production and precision ag. A huge, huge fall for the industry leader. And it really paints a picture of a market in a very steep downturn. But you know that headline number? It was actually hiding a much bigger and frankly more important story. See, this wasn't just a market slump, it was the backdrop for a crazy high-stakes tech war. This was the year these giants bet billions, not on just getting through the storm, but on using this crisis to completely dominate the next decade of agriculture through technology. So let's start with the giant in the room, John Deere. Faced with a crushing market, Deere didn't even flinch. They didn't pivot. Instead, they doubled down on a really high-risk, high-reward strategy. They spent billions to build up their high-tech fortress while their main market was actually shrinking. I mean, Deere's financial firepower is just on another level here. Generating over $6 billion in free cash flow during a down year is staggering. That cash let them keep their foot on the gas with a massive $2.3 billion R&D budget, all to fuel their dream of fully autonomous farms. And at the same time, that 22% sales surge in Brazil shows their global game plan is working, creating this really vital buffer against the slowdown in North America. But, and this is a big but, the red flags are impossible to ignore. That 17% revenue drop in their main division led to an even worse 41% collapse in operating profit. I mean, it just fell off a cliff. Then you throw in a $600 million hit from trade tariffs and a flood of used equipment that's basically choking off new sales. It just goes to show that even a titan like Deere can really bleed when the cycle turns against them. Okay, now for AGCO, which, wow, they took a radically different path. Instead of just trying to ride out the storm, they decided to completely rebuild their entire ship, right in the middle of a hurricane. This was such a brilliant and honestly risky three-step move. First, they shed their past, selling off that low-margin grain and protein business. Second, that sale gave them a $700 million war chest. And third, they used all that momentum to launch PTx, which is a new company designed to sell precision ag tech not just for their own machines, but for their competitors' machines too. And the early results are pretty stunning. This company went from a major loss to a profit of over $726 million. Their open market retrofit for strategy with PTx is a direct assault on Deere's closed ecosystem, targeting all those farms that run multiple brands of equipment. And crucially, they figured out how to lock in their key talent, dropping voluntary turnover way down to just 4.3% by giving their employees some skin in the game. But this whole pivot is walking a tightrope. Yeah, the company as a whole is profitable, but its core machinery business in North America is bleeding money, posting a $112 million loss. Overall sales are down quite a bit, and there's this serious accounting flag. The goodwill from their new PTx venture, which is basically the premium they paid for acquisitions, is at risk. If that venture doesn't grow fast enough, they could be forced to write down its value, and that would take a big chunk out of their profits. All right, so our next two contenders, CLAAS and Toro, they show us a third way. They chose not to fight the agricultural storm head-on, but to find shelter by leaning into their own unique and often overlooked strengths. And right here, we see two totally different survival strategies playing out. On one side, you have CLAAS, the specialist. They dominate the super stable market for livestock and dairy equipment, which is way less cyclical than row crops. Then on the other side, you've got Toro, the great diversifier. Their strength in stuff like golf course mowers and underground drills acted as this powerful hedge against the farming downturn. The resilience on display here is just remarkable. While Deere's revenue was in a free fall, CLAAS's dropped a tiny 1.6%. That's what stability looks like. Meanwhile, Toro's Pro division actually grew, and the company became an absolute cash machine. Its free cash flow conversion of over 145% means that for every single dollar of profit they reported, they generated almost $1.50 in actual cash. That is a sign of an exceptionally healthy business. So after surviving the absolute brutality of 2025, winning the future really comes down to one thing: technology. So let's move to the head-to-head comparison and see who is really best equipped for this algorithm arms race. Now, this chart tells a fascinating story, one that kind of defies expectations. While Deere spends the most money in absolute dollars, it's actually the German family-owned company CLAAS that reinvests the highest percentage of its revenue, a whopping 6.5%, back into innovation. That shows a really deep long-term commitment to tech that lets them punch way above their weight. And this table just perfectly lays out the fundamental clash of ideas in this tech war. You've got Deere, who is all in on the Apple model, a closed proprietary ecosystem where their green software works best with their green hardware. Then you've got AGCO making this huge bet on the Android model, an open platform with PTX designed to work with any color machine, trying to capture the whole market. CLAAS and Toro, meanwhile, are smartly focusing on just dominating their specific niches. So, after that deep dive, we get to the big question. Who actually comes out on top? Well, what the reports suggest is that the answer isn't so simple. It really depends on what kind of investor you are and what kind of strategy you truly believe in. So here it is, a summary of the core bull and bear cases for each company, just laying it all out. The bull case for Deere is its incredible scale and that tech lead. The bear case is its vulnerability to market cycles and political risks. For AGCO, the bull case is their brilliant pivot to high-margin tech. The bear case is the massive risk that the whole pivot fails. And for CLAAS and Toro, the bull case is their stability, while the bear case is, you guessed it, a potentially slower growth path. So here's the crucial point. There is no single winner. Instead, what really comes out of these 2025 reports are three very distinct investment ideas. If you believe in sheer scale and a dominant closed ecosystem, you bet on the tech titan, Deere. If you're looking for a high-risk, high-reward transformation, you bet on the turnaround play, AGCO. And if you just value stability and resilience above all else, you look to the steady compounders, CLAAS and Toro. Which leaves us with one final provocative question. As these machines become less about horsepower and more about processing power, as farms literally turn into fleets of rolling data centers, the whole game changes. The new prize isn't just selling steel. It's about who will control, analyze, and ultimately harvest the single most valuable crop of all, the data itself. You know, we've only really scratched the surface here. To explore all the financial data, the strategic analysis, and all the risk factors behind this explainer, you can download the complete, in-depth PDF report from our partners at HDIN Research. The link is right there on your screen. Thanks for watching.